In the Bronx, a man stood in a winter bank line for $2. Not $2,000. Not a broker's account. $2 in savings, small enough to fit inside a passbook and large enough, in 1930, to make him wait for hours. Around him, the rumor had already done its work. Someone said a bank would not let a customer sell shares. By the time the story moved down the street, people heard something worse: the bank might not let them have their cash. Police horses pressed against the crowd. Branch doors opened and closed. Men and women who had never cared about ticker symbols now cared about the solvency of a local bank. That is the contradiction of this episode. Leaders kept treating the Depression as a problem of confidence. But ordinary Americans were already acting on evidence. They did not need a theory. They had rent, wages, passbooks, and closed doors. A year after the crash, Thomas Lamont still looked like a man built for command. He turned 60 at his desk at J.P. Morgan, answering reporters, dictating letters, and commuting down the Hudson with newspapers laid out around him. Publicly, he remained fluent in reassurance. Privately, Morgan Partners' new recovery was not close. Wall Street had once counted on friendly newspapers and deferential profiles. By 1930, the tone had changed. Writers began describing the boom not as genius, but as salesmanship. A former National City bond salesman turned his anger into a book about the people who had sold securities to the public while insiders protected themselves. Charles Mitchell, who had once charmed nearly any room, was becoming harder to defend. The story was no longer only that prices fell. It was that trust had been sold retail, then withdrawn wholesale. The crash had become literature, journalism, and accusation. Confidence was no longer just failing. It was being investigated by people who had believed in it. John Raskob tried to answer blame with a radio microphone. He walked into an NBC studio on Fifth Avenue because the national argument had found him. Republicans accused him of financing attacks on Hoover. Editorial pages made him a symbol of the crash, the speculator who had told ordinary Americans that everyone ought to be rich. Raskob wanted to sound constructive. He talked about a 5-day work week, holidays, consumption, and investment. But the deeper purpose was political survival. If he could not erase his old market optimism, he could at least make Hoover own the present economy. That was one of the Depression's new rooms, not the exchange floor, but the broadcast studio. The old financial language had been joined by party warfare, planted stories, rebuttals, and the early machinery of mass persuasion. Blame had moved from whispered private meetings into the air. On November 5, 1930, Hoover's political fixer brought the midterm results into the Oval Office. The numbers were grim. Democrats had taken seats across the country. Hoover paced, trying to process the returns like an engineering problem. But politics was not a bridge calculation. It was a verdict. The pain had spread far beyond stock owners. Millions were out of work. Factory jobs had disappeared. Small banks were failing in towns that Wall Street barely noticed. Hoover still believed language mattered: avoid panic, speak of recovery, keep business psychology intact. The country heard something different. It heard a president saying sentiment was better than the evidence outside the window. By then, even the word depression had hardened. It was meant to sound less explosive than panic. Instead, it became the name for a national condition. And in New York, Franklin Roosevelt's easy re-election as governor showed Hoover the shape of the next fight. Then came the Bank of United States. It was not the central bank. It was a New York institution built around immigrant depositors, garment workers, shopkeepers, and small accounts. Its name sounded almost official, and that made the panic more dangerous. When a rumor spread through a Bronx branch, customers came for their money. More gathered at other branches. The biggest bankers in New York rushed to the Federal Reserve Building and stayed late into the night, trying to assemble a rescue. The room had all the old ingredients: powerful men, urgent phone calls, a merger idea, and enough money to suggest command. But this time the institution itself was too doubtful, the accounting too tangled, the public too frightened. The rescue did not hold. When the bank failed, it broke more than one balance sheet. It broke the comforting claim that 1929 had spared the banking system. Across the country, bankers drew the same lesson: conserve capital, call loans, protect yourself. That is how a market crash becomes a depression. Fear stops being an event and becomes a policy. In February 1931, Charles Mitchell sat before Carter Glass. The hearing could have become theatre. Instead, it became something more revealing: two men calmly debating the machine that had failed. Mitchell blamed credit outside the banks, money that rushed in to call loans and speculation. Glass blamed bankers for finding indirect ways to do what the rules were meant to prevent. For a moment, they even agreed that corporations should not be able to pour idle funds into market loans. But Mitchell still wanted less intrusion, less inspection, and more room for Wall Street to recover on its own. Outside the homes of the powerful, the city was changing. Men slept in makeshift shelters near Central Park. Hoover, exhausted, described himself as a repairman: an international crack here, an industrial leak there, an agricultural flood somewhere else. He still believed recovery would come from the cells of the economic body. The problem was that too many of those cells were hungry, unemployed, or afraid. In 1931, the Depression stopped respecting borders. Germany was under crushing pressure. American banks had helped knit together the post-war financial system, and now those threads pulled tight. If Germany defaulted, the pain would travel back to Lower Manhattan. Lamont urged Hoover to support a holiday on international debt payments. Hoover knew the politics were poisonous. Americans remembered the war. They did not want to forgive debts abroad while suffering at home. But the alternative was worse. When Hoover finally announced the moratorium, it looked like the bold act critics had demanded. It did not hold long. Austria's banking crisis spread fear through Europe. Britain left the gold standard. Markets convulsed again. The Dow suffered its worst monthly fall yet. Gold, currency, debt, and bank confidence were now part of one nervous system. The crash had begun with stocks. By 1931, it was about whether money itself could be trusted. By 1932, Hoover was replacing generals. Andrew Mellon, once the face of 1920s prosperity, had become a political burden. Hoover moved him out of Treasury and into an ambassadorship, then pushed the Reconstruction Finance Corporation as a way to lend emergency support to banks and companies. It was a major shift for a president who had resisted direct intervention. But even this rescue carried the old anxiety: help private enterprise, but do not make it look like ordinary depositors had a federal guarantee. Glass and Henry Stegall rushed through a 1932 banking law that loosened Federal Reserve lending to weak banks. Stegall wanted deposit insurance. Glass and Hoover opposed it. Hoover also became convinced that short sellers were attacking the market and his presidency. He wanted names exposed. Senate hearings opened, but the early questioning was clumsy. Richard Whitney lectured the committee. Mitchell deflected. Raskob denied betting against the country. The investigation was meant to prove action. Instead, it showed how little political theater could repair. On election night in 1932, Hoover listened from Palo Alto as the country moved on. Roosevelt won decisively. Democrats took the House and Senate. Hoover still believed he had turned a corner, and in one narrow sense there had been calmer months. But investors remained skittish, banks remained vulnerable, and the long delay before inauguration left the country suspended between two governments. Then Democrats forced the Reconstruction Finance Corporation to reveal which banks had received emergency loans. The loans had been defended as stabilizing and discreet. Once names leaked, secrecy looked like favoritism. Depositors began hoarding cash again. In the Senate, a nearly exhausted Wall Street investigation found an unlikely new lawyer, Ferdinand Pecora, a New York prosecutor with little time and a sharp instinct for public evidence. He chose Mitchell and National City because the public had been taught to see them as safe, prudent, and almost mythic. Now letters from ruined depositors poured in. The crash had become a depression. Next, it would become a trial.